No, I did, like I say, in a similar way, there's been a lot of policy that's come to the equation, and so we think we think the investment opportunity in Brazil is also pretty significant.
Thank you.
Great. One other question that I always get, Rick, from our clients, and actually something happened yesterday, which I believe is very relevant, and I should mention it to the people that are looking at this webinar, is that Mexico was actually able to go to the market yesterday and raise something like $6 billion, which I thought was a very positive piece of news from the standpoint of where we are right now and the uncertainty that we have in terms of the possible effects that the coronavirus is going to have on U.S. industry and therefore Mexican growth, et cetera. But so I believe and I think that this was also very positive because López Obrador, the president of Mexico, is not a very popular guy in Wall Street. So
that's right.
So it's good news that happened. So I know there's a lot of more juice in these bonds because the coupons are much larger, et cetera. But if you were to make a recommendation to somebody that is looking at this in terms of whether or not you should have an overweight exposure on EM hard currency bonds, or perhaps be more focused on high yield US, which is also paying a very significant amount of yield, how would you approach that difficult conundrum of whether or not which one of the two is perhaps more interesting? How are you guys looking at that?
So first thing, I think you were in our strategy meetings today, because that is what we were. that is literally what we were talking about and debating. And by the way, I just echo one of the comments you made. Not only Mexico raised a lot of money, but Pemex, the state, as you know, the state oil company, was just downgraded to high yield, and it was tremendous pressure and concern around that. And then to come to the markets. And in issue in Mexico is pretty impressive. And one of the things we're seeing across markets is I think people underestimate, if you're pricing some of these debt markets at the right price. I've never seen the amount of demand for income that we're seeing now. We broke records, I think, for 4 straight days in issuance in the U.S. in the investment grade corporate bond market. Getting a couple $100 billion done one week. I mean, just immense size. When the Federal Reserve, when the ECB, when the Bank of Japan and all the central banks drop rates down to these levels, people need the income. And so, I think the reason why I think you asked the right question is, now that a lot of these investment grade markets, things like U.S. mortgages, municipal bonds, et cetera, have moved to such low yields, people are like, I got to get yield in the portfolio. So part of why we were wrestling with this discussion today. We are quite frankly, including today, we started adding some hard currency debt in emerging markets, because some of the levels that are, we're looking at some of the hard currency debt, it was 6-7%. Depending on where it was. You're looking at levels now in the U.S. for corporate bonds that are 1.5% in 5 years and in maturities, short of the maturities. And high yield gets you similar yields depending on what sort of risk you want to take. We're erring on the side. We're running a bit more high yield than we are emerging markets. And I think the point that I think you were referring to, there are places in emerging markets that are still difficult. Places like Turkey is difficult. South Africa is difficult. Ecuador is difficult. Restructuring Argentina, obviously, difficult and going through a restructuring. So, the reason why Mexico, Brazil, Indonesia are places that we like investing in. They're places where you can get the return, and not just in some of the country debt, but also in some of the corporate debt. So we are going there. I would say in a ratio of about 65-35. We're doing a bit more in the U.S. high yield market, but it's the thing that is really important now in some of the characterization of U.S. high yield versus investment grade bonds is changing, because it matters more what industry you're in than it does what the rating agencies have given you based on where you were a year ago. So things like that were investment grade, the airlines are hard, the energy companies are hard, even if they're investment grade. Some of the retailing stores are hard, whereas some of the high yield businesses like cable, healthcare, technology, some of the industrials. That's where we're going, and some more industries as opposed to rating today. But on a ratio about 2/3, 1/3, more in high yield today as we're taking a yield. But like you're saying, we like some of this hard currency debt in EM, but we're just being a bit cautious around where we go, more so than we have pre-virus.